Okay? So what we've done is, in effect, we've protected ourselves from that sudden turn in the market, which actually, in hindsight, was a few weeks ago, isn't it? Now, I want you to think about, geez, if I had understood my exposure, if I had diversified, and if I had stop losses on everything, I'd be this much better right now. I want you to think about that. Put a number on it and think about that right now. If I'd just done what Carl just taught me how to do, how much better I'd be right now. But after the market turned suddenly, we're now in a bear market, aren't we? And more often than not, the prices are going to go down on a day than up. So we need to know how to profit from that move. Okay? Most people just sit there and they just hope it goes back up. I want you to be in a group of investors, a very elite group of investors that say, you know what? I'm so happy that prices are going down because I'm making so much money. Excuse me. Okay, basics of short selling. A little bit of jargon here. When we go long, just terminology, we want the share price to go up. Okay? If it goes up, we make a profit. If it goes down, we make a loss. That's what most people do in the markets. They go long. They want prices to rise. Going short is just the opposite. We want prices to go down. And I'll tell you right now, in the portfolio that I run at Australian Stock Report, the CFD report portfolio, we're very short. I want the market to go down. I really do. I hope we're just at the beginning of a big GFC. And the market falls a few thousand points. I really do. And the point I'm trying to get across here is, for the people that are making money when the market's going down, who are they making their money off? The people who are short, who are they making their money off? The people who are long. And the people who are short, who are making money when the market goes down, do you think they feel sorry for the people who are long? No, we don't. No, we don't. So I need to ask you, which group do you want to be in? And I love going long, don't get me wrong, but I go long when the market's rising. The market's going down, I get short. Now, I can't have it both ways, can I? Because if I go short, the market goes down, I make money. What does it mean if the market goes up? I'm going to lose money. Let's illustrate this with a nice little analogy. It's another property analogy, because I find people understand property investing, but when it comes to the share market, they're completely baffled. Okay, so let's use another little property analogy. Let's say that your neighbour was going on holiday to Thailand, okay, which is a crazy thing to do these days. And by the way, he was wearing a red T-shirt. All right, so he's on his way to Thailand, and before he went, he gave you some really important documents to look after. Okay, now you've got this envelope; it's sealed. It's just a bit of a thing there. What do you do? You have a peek, don't you? Okay, you can't help it. You have a bit of a peek. In that envelope is the deed to his house. Now, you've got a view that property prices in your suburb are about to tumble. But you don't want to sell your house because you need somewhere to live. What can you do? Sell your neighbour's house. Okay, now it does say up there, big red, hypothetical. Okay? So what you're going to do is you're going to get a price for your neighbour's house in the market. And you can get $500,000 for your neighbour's house. You sell his house, what comes into your bank account? Not a trick question. $500,000 sitting in your bank account. And you're right. Property prices plummet over the next couple of weeks that he's away. And you're able to buy that house back for $400,000. So when you buy something, what comes out of your account? Money. Yeah. So 500 went in, 400 went out to buy that property back. What's left? $100,000, isn't it? You've got $100,000 left in your account. Your neighbour comes back, what do you do with the deed? Give it back to him. Nobody's any the wiser. And what you've effectively just done is you've just short-sold your neighbour's house. It's hypothetical, okay? Now, let's think about the process here. We saw an asset which was overvalued, didn't we? And we sold it. But we had to borrow that asset first, didn't we? Okay, we borrowed the asset, we sold it, it went down, we bought it back at a lower price, and the difference was our profit, wasn't it? Okay, so when it comes to shares, it's exactly the same concept. You can do this on shares. Most people don't even know this. But effectively, you can borrow these shares, sell them at what you perceive to be a high price, and when they come down, you buy them back. And the difference, again, is your profit. So what we're going to do is we're going to do BHP. We're going to type in 100 shares in here. And the reason why I'm typing in 100 shares is I want to limit my exposure on BHP to divide 100 by 100, Simon. $1 per cent movement, isn't it? So if I trade in 100 shares of BHP, this is why I showed you this before. If I do this transaction and BHP, if I buy them at 40 and BHP goes to 40 and 1 cent, I make $1, isn't it? Yep. If I buy them at $40 and they go to $41, I've made $100, 100 cents, and so on and so forth. But I actually don't think BHP is going up. I really think it's going to go down because here we are at the start of the next GFC. So I type in 100 shares, and before I do anything, what do I need to do? It was step 3 of protect what you've got. Always use a stop loss. So where should I put my stop loss, I wonder? It could be 10%, yeah. Trailing, we're getting to more complex concepts now. Let's just stick with the basics. Can I put my stop loss, can I put it, say, $1 away? Is that okay? $1 away. So do I put it at 39 or 41? That's the question. 39 or 41. If I'm going short, which way do I want the price to go? I want it to go down, don't I? Yeah. So it's got to go at 41. Do you see how that works? Some people have got it, some people don't. That's okay. If I'm going short, I want the price to go down. If it goes down, I'm making a profit. So my stop loss needs to go up, doesn't it? So I put my stop loss at $41, which means at $1 for every cent movement, I'm risking $100. Is that something people would feel comfortable doing? Risking $100 to try and make money if BHP went down? Yeah, you can do it. $100 is your worst case scenario. What's your best case scenario? Could be anything, isn't it? So what you've done is you've limited your risk by using the stop loss, but kept your reward way open, haven't you? That's what you should be doing. Okay, so now the question is, same with our neighbour's house, in terms of the orders of the transactions, what did we do first? Did we sell first or did we buy first? We sold first. We had to sell the asset at a high price, didn't we? So which button are we going to click right now to go short BHP? Sell, yeah. Sell. So we hit the sell button, and what that does is initiates for us a short trade. Now, we've got an obligation to buy back these BHPs somewhere down the track. Just like we had an obligation to buy that house back for our neighbour, didn't we? Because he would have been pretty cranky if he came home and somebody else was living in his house. So at some stage down the track, we've got to buy these BHP shares back. And we want to buy them back ideally much lower, don't we? Just like with that property. Look what happened to BHP. Wouldn't that be nice if you just click a button in real life and the shares just go where they're supposed to? BHP's gone down by $10, hasn't it? $10. And if we're making $1 for every cent it's gone down, I wonder what our profit would be in this case. $1,000, isn't it? We've made $10, which is 1,000 cents, $1,000 profit. I think that's a pretty good profit. Why don't we take it? How do we get out of this trade now? We need to buy, don't we? Same as if we sold our neighbour's house first, we have to buy back later. If you sell BHP first, you need to buy it back later as well. Okay? That completes the transaction. Sitting in your account now is $1,000 profit. Now, everybody who was holding BHP, who was long BHP from $40 down to $30, how are they feeling? Miserable. How are you feeling? Wonderful. You see how this just really changes the ballgame now, doesn't it? If you're able to do this, does it matter which way the market goes? No. And this is why I was saying before, I'm so excited at the prospect of the market going down a couple of thousand points. Yet that probably scares the pants out of everybody in the room, doesn't it? Because you're not in that group of winning investors yet. You're not in the group of investors who can profit from a falling market. Because you tell me, does the market go up faster or down faster? Down faster. So which is the market that's going to make you the fastest money? The bear market, isn't it? That's why I'm excited by the prospect. Not enough people, I think, like that. And just judging by the looks on your faces when I said, I want the market to go down 2,000 points, I'm thinking not many people in the room are thinking like that either. Okay? All right. So that's what I've got to talk to you about today on protecting what you've got. There's some really good methods in there. Hopefully you've been taking notes. You go back, review those notes. Of course, you can get in touch with me. I'll give you my email address at the end of it, and if you need any further clarification.